In this presentation, we'll look at tax software for some scenarios related to interest income. For more accounting information and accounting courses, visit our website at Accountinginstruction.Info. In 40, we have a single individual, no dependents. If we go to page 2, this is where we will report the income. So we have the wages, we're going to say are 100,000 of W-2 wages. This is the new item here, the 310 of interest income in the income section, bringing the income up to the total income, line 6, 100,310. Then we have the adjusted gross income, no adjustments to it, 100,310. Standard deduction for single individual, 12,000 taxable income down to 88,310, and then the tax is going to be calculated on that at the 15,488. So we're going to give that is going to be our total tax will be the 15,488. Note that we do not see here the Schedule B being highlighted by this particular type of tax software, and that indicates from this software that it's not something that is a required schedule, and that's because it's below the threshold to need any added reporting requirements other than this. We do have a schedule and a worksheet here that reports Bank 1, that's going to be the institution, but we don't have a Schedule B, not required because it's below the threshold. If we go to Schedule B, we could see that we could fill out, of course, the form, but it's not something that is necessary to include as part of the return in this situation. Doesn't hurt for more detail, but it's not a requirement. If we then take a look at the tax summary, scrolling down, we're going to say that the marginal tax rate is 24 and the effective tax rate or average is 1750. What we've done now is change the scenario, and changing the scenario by increasing the interest by another 2,000. So now we can see that we're at 2,310. That would do what we would expect, bringing the 100,000 W-2 income up to 102,310. We've got the 12,000 standard, 90,310 taxable income, 15,968 would be the tax then. We can see now that the Schedule B is something that's going to be required, indicated by this particular software as it being highlighted. If we go to Schedule B, we have two institutions where we have this income from, most likely a result of two 1099 interest forms that we then input into our system. We have now added another 5,000 of interest income, but we could see here that that's going to be tax-exempt interest income. So now we have tax-exempt interest income where we included another 5,000. You'll note that if we look at the calculation for total income, it's not part of the calculation for total income. We've got the 100,000, the 2,310, not part of the calculation for the 102,310, but still had to report it. In other words, we may get a 1099, which will have income that is going to be non-taxable. We'll still have it and we'll put it into the system. As we do so, we will see it. It will be reported to the IRS, but may not be included in the total income calculation. If we then, and we could see then that also the total tax remains the same as we saw in the prior example. 5,000 is obviously an extreme amount for most people for a tax-exempt interest, but it just gives a good example to see that there's no effect on the taxes for the inclusion of that tax-exempt interest. For more accounting information and accounting courses, visit our website at Accountinginstruction.Info.